Welcome to the deep dive. We take the source material you give us and we pull out the essential truth. Today we're looking at a really interesting document, a major bank's 2013 shareholder letter. And the core question is, well, how does a giant financial institution deal with maybe the biggest legal storm in its history, while at the same time it's spending billions to prepare for a whole new era of regulation?
It's a fascinating read, honestly, because it's just full of these apparent contradictions. The letter's author even summed up the year using that classic phrase, a tale of two cities, the best of times, the worst of times. So our mission today is really to unpack that for you. How did both of those realities exist side by side in 2013?
Okay, let's get into it. The worst of times part, well, it jumps right out when you look at the net income. They reported about $17.9 billion in profit on almost $97 billion in revenue. But that number doesn't really tell the whole story, does it?
No, not at all. It was seriously distorted, skewed by, well, pain. They had these enormous legal settlements hanging over them from past issues, and the hit after taxes, a staggering $8.6 billion. I mean, that's not just noise. It's a huge, huge financial impact.
But then there's the flip side, the best of times, which, the letter clearly wants you to focus on. If you actually pull out those big legal costs and maybe a couple other one-time items, the core businesses, the actual day-to-day operations, they generated something like $23 billion in profit.
Right. And that difference, that gap between the $17.9 billion they reported and the $23 billion the core engine earned, that's really the heart of the story for that year. It shows that even while they were paying this massive price for past events, the bank itself, its main functions were incredibly strong and profitable.
Right.
So we need to understand, how do they manage that? What was the strategy to keep the past from sinking the present?
Okay, so let's dig into that $8.6 billion pain point first. Where did it actually come from? It sounds like it was mainly two big things.
That's right. First, you had the lingering effects from the Chief Investment Office issue, the London whale, people called it. That blew up in 2012. And second, the much bigger piece, financially, was all the legal fallout tied to mortgage securitization.
And these weren't new problems from 2013, were they? We're talking about mortgages mostly from the mid-2000s, like 2005 to 2008, a lot of which they actually inherited when they bought Bear Stearns and WAMU during the crisis.
Exactly. These were legacy issues. And the decision management made, which the letter highlights, was pretty critical. They basically decided the best path was to settle as much as we could all at once, even though it came at a, quote, high price. Okay. The idea was, look, let's pay up, get this behind us, so we can focus completely on our clients in the future. A strategic clearing of the decks, really.
And to kind of justify taking that hit, the letter then immediately pivots to the long-term picture, right? Showing how they've created value over time.
Right.
We talk about stock performance versus the S&P 500 going back to 2000. But the metric they really hammer home is tangible book value per share.
Okay, yeah, let's pause there for a sec, because not everyone listening might live and breathe bank financials. Why tangible book value? What is it, simply, and why does management prefer it so much?
Good question. So think of tangible book value per share as like the core hard equity value of the company. It's basically assets minus liabilities, but you also subtract out intangible things like goodwill from acquisitions, then divide by the shares. It represents the real physical capital base per share. Management argues it's a much better measure of fundamental value creation than, say, the daily stock price, which can be volatile.
Right, it's about the underlying capital accumulation, and the numbers they show are, well, they're pretty striking. Since the big merger back in 2004, their tangible book value per share grew at a compounded rate of 14.5% per year.
Yeah, and compare that to the S&P 500. Over the same time, its compounded gain was about 7.4%. So they're essentially making the case, okay, yes, we took a massive legal hit, but look, our fundamental value engine is still crushing the broader market. That's their argument for resilience. And that resilience, they argue, comes from what the letter keeps calling the fortress balance sheet. In this post-crisis world, what does that actually mean? What does a financial fortress look like on paper?
Well, it means a whole lot more capital and a whole lot more liquidity. Way more than before the crisis. They point to their Basel III Tier 1 common ratio, that's sort of the gold standard for high-quality capital that can absorb losses. It went from 5.0% back in 2007, before the storm hit, all the way up to 9.5% by the end of 2013. That's a much, much bigger cushion against potential shocks.
And the liquidity numbers are just, well, mind-boggling. They said they held $741 billion in what they call HQLA, highly liquid assets.
Yeah, HQLA. Think of it as basically cash, or stuff that's easily turned into cash with almost no risk. So deposits at central banks, U.S. Treasury bonds, things like that.
Yeah.
And the comparison they made was pretty incredible, that $741 billion in safe liquid assets was almost the same amount as their entire book of loans to customers, which was $740 billion.
Wow. But wait, if you have that much money tied up in super safe, low return assets, doesn't that kind of hold back lending? Isn't that inefficient in a way?
Ah, that's the tension, isn't it? That's the friction built into the new rules. They kind of acknowledge that, yes, it changes the cost of doing business, but the number one priority became stability and survival, maybe even over maximizing every last bit of profit efficiency. And having that financial strength allows them to operate at this incredible scale. I mean, in 2013 alone, they provided over $2.1 trillion in credit and capital raising for clients. They touched half of all U.S. households, served 80% of the Fortune 500. The scale is just immense.
And that scale, that reach, it feeds directly into what seems like their core competitive edge, the whole
Yeah.
cross-selling strategy.
Oh, absolutely. This part's really interesting. They actually try to quantify the value of having all these different businesses, commercial banking, retail, investment banking, asset management, all under one roof. Their estimate, that combination generates something like $15 billion in extra revenue every year, just from the synergy.
Whoa, hang on. So $15 billion a year, basically created just by connecting the dots between their existing clients across different divisions. That's like a whole massive business unit built purely on internal referrals and integration. That's a powerful moat.
It really is. It's the network effect in action. They give specific examples, too, like nearly 30%, 29% to be exact, of the North American investment bank's revenue came from clients who are primarily commercial banking clients.
Yep.
And you see it with the retail branches, too. Over half, 55% of their commercial bank clients, and about a third, 35% of their private bank households, actually use the Chase retail branches pretty regularly. So it's not just one bank, it's like four interconnected powerhouses feeding each other, creating that $15 billion revenue boost. Plus, they estimated about $3 billion in cost savings annually from running it all together.
And you see the results of that strength and scale in their market position, right? Number one U.S. credit card issuer, number one in global investment banking fees, top marks for customer satisfaction among big banks in 2013. The machine was definitely working.
Okay, so now we pivot. We move from dealing with the past to investing in the future. Or maybe, more accurately, the cost of adapting to the future. This whole section is about adjusting to the new global financial architecture. You know, Dodd-Frank, Basel III, the Volcker Rule. And the letter makes a really clear point up front. These new rules have, and I'm quoting here, unquestionably made the global banking system safer.
That's quite a strong statement, sort of an endorsement of the overall regulatory direction, but that safety clearly came with a massive price tag, and the letter is pretty explicit about the sheer resources involved.
Oh, yeah. They laid it out. They talked about adding 13,000 employees between 2012 and the end of 2014, just for roles supporting risk, compliance, and controls. Think about that number, 13,000 people basically focused on oversight and managing the new rules.
And within that, 8,000 people were working just on anti-money laundering programs, AML. Plus, they estimated spending over $2 billion extra just on the overall control efforts in that 2-year period. This is clearly the new cost of entry, the baseline for operating as a global bank.
And this huge increase in overhead, it fundamentally changes the math on some of their products and services. Because of the new capital and liquidity rules, things that used to be maybe marginally profitable suddenly become, as they put it, hugely unprofitable. So they have to reprice them.
Right. So the simple takeaway seems to be the new rules make holding anything short-term or very liquid much more expensive for the bank. What were some of the key examples they gave of how clients would feel this repricing?
Well, take non-operational deposits. These are basically short-term funds clients might park at the bank, almost like a convenience. Now, banks have to hold a lot more capital and high-quality liquid assets against those deposits. Suddenly, they don't make economic sense for the bank. The letter predicts banks will try to minimize these, essentially pushing clients to put that cash into money market funds instead.
Okay, so deposits get trickier. What about lending? Even basic credit lines get more expensive.
Yeah, things like committed, undrawn credit lines, the revolvers that companies rely on for flexibility, the potential cost increase there, up to 60 basis points.
And just quickly for listeners, a basis point is 1/100th of 1%, so 60 basis points is 0.6%. That's a noticeable jump in the cost of having that safety net available.
It is. And they also flagged short-term trade finance potentially going up by maybe 75 basis points. So this isn't just internal stuff. It directly impacts the cost of capital and doing business for their clients. It's a fundamental shift.
So strategically, what do? They say they'll accept suboptimal profits for a while to keep those important client relationships. But they're also simplifying, right? Getting out of some businesses.
Exactly. They mention exiting things like physical commodities, trading, and originating new student loans.
Mm.
It's a pruning process. Reduces top-line revenue by maybe $2.8 billion, but interestingly, it barely touches the bottom line, only about $0.3 billion in net income impact, which suggests they're really focusing on cutting lower margin or non-core activities to double down on where they make real profit.
Okay, so we've covered the past pain and the present costs of regulation, but the letter definitely doesn't end there. It shifts pretty dramatically towards the long-term outlook, expressing a lot of confidence. Where is that optimism rooted?
It really comes down to global growth potential and basic needs. They cited projections for world GDP to grow around 7% a year through 2023. That's huge. And they pointed to these massive global infrastructure requirements, estimated something like $57 trillion needed by 2030. Growth on that scale needs financing, needs complex financial services, and, well, a global bank like them is set up perfectly to play a central role in that.
And domestically, they really emphasize their belief in the U.S., right, and
Mhm.
abiding faith in the United States of America. They
Mhm.
list out the core strengths: strong military, top universities, rule of law, entrepreneurship, the world's deepest financial markets, things you just can't easily replicate.
True. But they don't pull any punches about the things holding the U.S. back either. This is where they get into policy friction. They call out things like too much regulation, uncertainty around healthcare reform back then, political fights like the debt ceiling standoffs, also concerns that entitlement spending was crowding out investment in infrastructure and R&D. And they flagged issues with corporate tax and immigration rules potentially pushing capital and talent to other countries, essentially saying the U.S. has huge advantages, but policy choices are kind of getting in the way.
Okay, let's talk about the big financial worry back in 2013. QE tapering, quantitative easing. The market seemed terrified about the Fed potentially pulling back.
Oh, yeah. That was the dominant fear, the taper tantrum environment. The letter actually offers a pretty calm, almost contrarian view. They basically argued, look, the U.S. economy, especially if it's growing decently, can handle the Fed eventually shrinking its $4.5 trillion balance sheet. And it felt the market panic was maybe a bit overdone.
And they made a pretty bold call on interest rates too, didn't they? Predicting normalization would happen faster than people expect.
They did. They saw normalization as a good thing, ultimately. And they even put some numbers out there for what normal might look like.
Yeah.
Short-term rates, maybe in the 3% to 4% range, and the 10-year Treasury yield around 5%, give or take.
Right, and here's the kicker for the bank itself. What does that normalization mean for their bottom line?
This is key. They saw rising interest rates as a huge tailwind, a big plus, they called it. Their estimate was that a return to more normal rates could boost their after-tax profits by around $6 billion over, say, 3 to 5 years, assuming other things stayed equal. That's an enormous potential lift just from the interest rate environment changing.
So a lot of their future profit growth was kind of baked in, just waiting for rates to normalize. But they weren't just sitting around waiting, were they? What about internal innovation?
No, definitely not just waiting. They also talked about focusing on things like building better systems for managing client data, getting smarter about market segmentation, and investing heavily in big data expertise, even setting up their own think tank, the JPMorgan Chase Institute, to publish research and insights. So actively looking for efficiency gains and new advantages in a world where tech and compliance were becoming increasingly intertwined. Hashtag tag outro, Grovey.
Wow. Okay, this has been a really thorough look at a document that, as you said, captures this incredible tension. On one hand, paying a massive multi-billion-dollar price for past mistakes, some inherited. On the other, spending billions more to re-engineer the bank for a much tougher regulatory future. And yet, through it all, projecting this real confidence underpinned by things like that estimated $15 billion annual synergy from their combined businesses.
Absolutely. That Tale of Two Cities theme really holds up. You see the unavoidable costs, cleaning up the past, adapting to the new rules, it's huge. But it's balanced by this deep-seated belief in long-term global growth and, frankly, the sheer competitive power of their integrated model. They clearly believe their core strengths would win out.
You know, the letter made an interesting observation near the end. It noted that people in the money economy finance folks obsess over every little regulatory tweak and interest rate move. But most people out there in the real economy, the letter mentioned the 145 million working Americans at the time, they don't really pay close attention to all that financial plumbing.
Right. And that leads to a really interesting question to leave people with. Consider this. We're in this environment, maybe still, of constant, complex, expensive regulatory evolution in finance. How much should those intricate mechanics of the financial system really influence the day-to-day decisions of an average business owner or just a consumer operating out there in the real economy? And maybe more importantly, where do those two worlds, the complex financial system and the real economy that depends on it for credit and growth, where do they inevitably collide, especially when times get tough? That collision point,
Hmm.
that's often what shapes what happens next.
A fascinating point to ponder. Where do those worlds connect and disconnect? We'll leave it there. Thanks for joining us for the deep dive.